Okay, let's unpack this. You've worked hard, built significant wealth. Maybe that came from a successful business you sold, perhaps highly appreciated real estate, or often it's a large chunk of stock from the company you helped build or have worked at for years. But here's the reality. Accumulating that wealth is one thing. Managing it effectively, particularly navigating the tax landscape, is an entirely different challenge.
It really is.
It's not just an annual chore. It's a continuous, integral part of smart investing. And if you're not proactively using every tool available, well, are you leaving substantial money on the table?
That's the core question, isn't it? For high net worth investors, tax efficiency isn't just a small optimization around the edges. It can dramatically influence your after-tax returns, your ability to reinvest, your legacy planning, and, your overall financial freedom.
Yeah.
Strategies that seem straightforward on the surface can unlock significant value, but also come with pitfalls if not executed correctly.
Exactly. So our mission today is to take a deep dive specifically into tax loss harvesting, a tool you've likely heard of, but one that holds surprising depth and becomes incredibly powerful in the context of complex H&W portfolios.
Right.
We're going to go beyond the basic definition, explore the common missteps that can completely negate the benefits, and then pivot to how these techniques, combined with advanced strategies and tools like direct indexing, are essential for dealing with significant concentrated stock positions, navigating alternative investments, and managing future financial windfalls.
And we're doing this dive using your provided source material, a collection of articles and research focusing on everything from the detailed errors people make when harvesting to the unique tax considerations of asset classes like private equity or commodities, the challenge of managing that big block of company stock, and the evolving landscape of direct indexing as a sophisticated tax management solution.
Think of this as your personal guide to understanding how to turn potential tax liabilities into opportunities for growth and optimization. We'll start with the absolute fundamentals, what tax loss harvesting is and why it matters.
Good place to start.
Then, we'll spend some time dissecting those common pitfalls, drawing heavily from one source's detailed list of ways people stumble. Understanding the traps is just as important as understanding the tool itself.
Absolutely. And armed with that foundational knowledge, we'll explore the more advanced applications. We'll touch upon the tax nuances of alternative investments, which require a different lens than traditional stocks and bonds.
Right.
Then we'll dedicate significant time to the specific prevalent challenge of concentrated stock positions and how advanced tools like direct indexing are fundamentally changing the game for managing that risk tax efficiently, and how they can be used proactively to prepare for future large capital gains events.
It's a comprehensive look, but by the end, our goal is for you to feel much better informed about how strategic tax management, particularly through tools like tax loss harvesting and direct indexing, can be leveraged as a powerful component of your overall wealth strategy.
So let's begin at the absolute beginning. What is the fundamental concept of tax loss harvesting?
Okay, let's really unpack the core idea. When we talk about tax loss harvesting, what's the simple definition?
At its heart, it's the deliberate act of selling an investment that you currently own for less than you paid for it. You are intentionally realizing that loss while the investment is trading below your purchase price.
Right, you're booking the loss.
Yeah.
But typically you don't want to just exit the market or that specific asset class. You want to maintain your investment strategy, don't you?
Precisely. That's the second critical step. Immediately, or sometimes within a minute or two, you then buy a different but very similar investment. It's often referred to as a partner security.
A partner, okay.
The goal is to get back into an investment that behaves almost identically to the one you just sold, thus maintaining your exposure to that market segment, but without running afoul of IRS rules.
Got it. You captured the tax loss on the sale, but you're right back in the market position you wanted to be in. So you've generated this loss for tax purposes. How does that actually translate into a benefit on your tax return?
This is where the payoff comes in. The IRS provides a clear path for using these realized capital losses. The most significant way is that you can use an unlimited amount of these losses to offset any capital gains you've realized in the same tax year.
Unlimited offset. So if I sold one fund and had a $75,000 gain, and I tax loss harvested another position for a $75,000 loss, those essentially cancel each other out from a tax perspective.
Exactly. Your net capital gain is zero, meaning you owe zero capital gains tax on that $75,000 gain. This is incredibly valuable if you're actively rebalancing, selling appreciated assets, or have other capital gains anywhere in your portfolio.
What if the losses I harvest in a year are more than the capital gains I have? Say I have $10 in gains, but harvest $20 in losses.
That brings us to the second use case. If your total capital losses for the year exceed your total capital gains, you can then use up to $3,000 of that net capital loss in your example. That's $10 of net loss. You can use $3,000 of it to offset your ordinary income.
Okay, so reducing my taxable income from salary, interest, things like that.
Precisely. Saving you taxes at your marginal ordinary income rate, which is typically higher than capital gains rates for H&W individuals.
That $3,000 deduction against ordinary income doesn't sound huge on its own, but I guess that's a recurring annual benefit if you have losses.
It adds up. As one source points out, for someone in the top federal tax bracket, that $3,000 deduction against ordinary income could translate to about $1,361 in federal tax savings each year. It's certainly worth capturing if you have the losses available.
Okay, so unlimited offset against capital gains, up to $3,000 per year against ordinary income. What happens if I still have unused losses after doing that in a given year? Like in my example, I used $10 against gains, $3K against income, so I still have $7K left for my $20K loss.
This is another key advantage. Any remaining net capital losses can be carried forward indefinitely to future tax years. They don't expire.
Indefinitely, wow.
Yep. You can use them to offset future capital gains or against the $3,000 ordinary income limit in subsequent years, potentially for the rest of your life. This is how building a large pool of carried forward losses can become a significant tax asset.
So whether you're harvesting a modest $5,000 loss or a substantial $100,000 loss, as mentioned in the sources, you've created this tax benefit that you can utilize now against gains or limited ordinary income, or save for a future year when you might have larger gains.
That's the fundamental mechanic. Sell low, buy similar, generate a tax asset. Sounds simple, doesn't it?
It really does. But then you read an article like the one in our sources, titled something like 13 Ways to Screw Up Tax Loss Harvesting, and you realize the execution is where things get tricky. Where are the most common places people fall down?
This is where the nuances of the tax code and brokerage operations really come into play. One of the most fundamental mistakes, and one the sources emphasize, is trying to perform tax loss harvesting within a retirement account.
Wait, you can't tax loss harvest in a 401k or IRA? Why not? Seems like you'd want to capture losses anywhere you can.
You absolutely cannot, and it's a critical point. The reason is straightforward. Capital gains and losses are irrelevant inside tax-advantaged accounts like 401k, traditional IRAs, Roth IRAs, HSAs, or 529 plans.
All right.
The growth within these accounts is tax-deferred or tax-free already. Since you don't pay capital gains tax on any gains inside these accounts, you receive zero tax benefit from realizing losses there.
Okay, that makes sense.
Trying to harvest a loss in a 401k is simply a wasted effort from a tax perspective. Pointless.
Okay, that makes perfect sense. If there's no tax on the gain, there's no benefit from the loss. So rule number 1, tax loss harvesting applies only to taxable brokerage accounts. What's the next big one, and probably the rule most associated with TLH pitfalls?
Ah, yes, the infamous wash sale rule. This trips up a lot of people, and conversely, some people become overly cautious because they misunderstand it.
Right.
The rule says you cannot claim a loss if you sell a security and then buy that same security or a substantially identical one within 30 days before or after the sale date.
So that creates a 61-day window, the day of the sale, plus 30 days prior, plus 30 days after.
Exactly, 61 days total. If you sell at a loss on day X, you must avoid buying back that specific security or its substantially identical partner anywhere in your accounts between day X minus 30 and day X plus 30.
And if you do buy within that window?
If you do, the loss is disallowed for the current tax year, and its value is instead added to the cost basis of the replacement shares. So you don't lose the loss forever, but you defer it, which defeats the purpose of harvesting now.
And the source gives a rather tricky example of how this can happen unintentionally, even if you buy before selling.
Right. Imagine you buy shares of stock ABC on March 15th. A few days later, on March 20th, the price has dropped, and you sell some shares of ABC that you bought, say, last year at a loss.
Okay.
Because your March 15th purchase falls within the 30-day window before your March 20th sale, it triggers a wash sale on the March 20th sale.
Whoa. So even though you bought before the sale because you still hold those newly bought shares and they are within that 30-day window of the sale, the loss is disallowed.
That's the key. To claim the loss on the March 20th sale, you would also need to sell the shares you purchased on March 15th. It's not just about buying after selling, it's about having bought or sold within that 61-day window across all your taxable accounts.
That's a subtle point that's easy to miss. You have to look at all your activity for security within that window. Now, here's an interesting detail from the source that seems counterintuitive.
Yeah.
The wash sale rules currently do not apply to crypto assets.
That's correct, according to the source. Because of how they are currently treated under tax law as property, not securities, you could potentially sell Bitcoin at a loss and buy it back immediately to realize the loss for tax purposes.
So you could capture losses during price dips simply by selling and rebuying the same crypto without waiting 31 days.
The source indicates that's possible under the current rules for wash sales as they apply, or rather don't apply, to crypto. However, it's important to reiterate the source's caution. This doesn't magically increase the total loss you have on a single block of crypto, and your investment decisions should always be driven by your strategy, not solely by tax maneuvers.
Good guidance. Don't let the tax scale wag the investment dog. Still, a useful nuance for crypto investors.
Yeah. Okay, so running afoul of the wash sale rule is pitfall 2. What's pitfall 3, which you mentioned is related but slightly different?
Pitfall 3 is actually the opposite problem.
Yeah.
Worrying too much about the wash sale rule, particularly the phrase substantially identical.
Ah, yeah.
People often freeze up, unsure if swapping from one fund to another is allowed. Like, if I sell a Vanguard Total Stock Market ETF, VTI, can I buy an iShares Total Stock Market ETF, ITOT? They track the same index. That feels substantially identical.
This is exactly the scenario the source addresses. It states that generally, as long as you are swapping into a different stock or a different fund, it's considered acceptable by the IRS, even if the funds track the same index.
So even though VTI and ITOT both track the U.S. total stock market, because they are legally distinct funds managed by different companies, swapping between them is usually fine for TLH purposes.
That's the common practice. And the source states the IRS has not historically challenged this. The argument is they are distinct legal entities. Even if their underlying holdings are very similar because they track the same benchmark, they hold different shares, even if sampling the same index, and are managed separately.
What if you want to be even safer? Maybe avoid any gray area.
The source suggests swapping for a fund that tracks a slightly different but still highly correlated index. For example, swapping from a total stock market fund to an S&P 500 fund. The source notes their correlation is extremely high, like 0.99, so your market exposure barely changes. But one fund holds maybe 4,000 stocks while the other holds 500. The argument that they are not substantially identical becomes much stronger.
Okay, different funds tracking similar or slightly different indices are generally considered safe for the substantially identical test. Where does definitely apply, though? Where can you not swap?
The source clarifies that it does apply if you exchange between different share classes of the exact same fund. For example, selling shares of a Vanguard Admiral share class mutual fund and immediately buying shares of the corresponding Vanguard ETF that represents the same underlying portfolio.
Ah, okay. Same underlying fund, different wrapper or wash sale.
Exactly. That would be a wash sale. Good distinction. Mutual fund shares and their corresponding ETF share class from the same fund family are substantially identical. Different funds from different families, or even the same family but different indices, are usually not.
And what about that fascinating, almost unbelievable point the source made about 401ks and wash sales?
Yes, this is another angle under Pitfall 3 that surprises people. The source claims that if you sell shares in your taxable brokerage account at a loss and immediately buy the exact same shares in your 401k account, it does not trigger a wash sale.
That seems completely counterintuitive. I thought the wash sale rule applied across all your accounts, including retirement accounts.
The rule generally applies across all accounts, but the source specifically states that the wash sale rule does not apply to 401k. It's a peculiarity of how the rule is written or interpreted.
Wow.
So while it might feel like you're trying to game the system by buying the exact same thing in your 401k, according to the source's interpretation, it doesn't violate the letter of the law for 401k. It is, as they put it, a peculiar loophole.
But not for IRAs.
Correct. They explicitly note that the rule does apply to IRAs, both traditional and Roth. So selling in taxable and buying the same security in an IRA will trigger a wash sale.
Wow. So a 401k might offer this strange workaround, but an IRA does not. That's a critical detail for anyone with both types of accounts. Okay, beyond the wash sale rules, what's another common pitfall? Let's move on.
Let's move to pitfall number 4. Inadvertently turning qualified dividends into non-qualified dividends. This is a tax trap that often goes unnoticed until tax time.
Ah, yes. Qualified dividends are great because they're taxed at the lower long-term capital gains rates. How does TLH mess that up?
To have a dividend treated as qualified for tax purposes, you have to meet a specific holding period requirement. You must own the stock or fund for more than 60 days during the 121-day period that begins 60 days before the stock's ex-dividend date.
Okay, a 61-day holding period centered around the ex-dividend date, basically.
Right, so if you receive a dividend and then tax loss harvest, meaning you sell the stock too soon after that dividend payment.
You haven't held it long enough.
Exactly. That dividend you just received no longer meets the qualified holding period test. It gets reclassified and taxed at your higher ordinary income tax rate instead of the lower qualified dividend rate.
Ouch.
The source provides a concrete example. A $1,000 dividend in a top tax bracket could see its tax cost jump from maybe $238 at the qualified rate to $408 at the ordinary income rate. That's a $170 difference right there.
So if the market hasn't dropped significantly since you bought the stock, the tax savings from the loss harvest might be less than that $170 extra tax you just created on the dividend.
Precisely. You could easily end up worse off paying more in dividend tax than you saved through the loss. The source notes this is a particular risk in swift, sharp market downturns.
Makes sense.
In longer bear markets, however, you typically have more than enough time, often months, to satisfy that 60-day holding period after the dividend before you need to consider harvesting.
So checking the ex-dividend date and respecting the holding period is crucial before harvesting, especially if the potential loss is relatively small compared to recent dividends. Okay. What about pitfalls related to the actual mechanics of trading at different brokerages? The plumbing, so to speak.
This brings us to some interesting anecdotes from the sources. Pitfall 5 details a specific issue someone encountered at Fidelity when trying to exchange between two mutual funds from different fund families.
What happened there? I thought exchange meant simultaneous.
Well, that's what you'd hope. But in this case, instead of the sale and the purchase happening simultaneously, the sale of the first fund executed on one day, but the purchase of the second fund didn't happen until the next day.
Oh, no. And in a volatile market, being out of the market for even one day can cost you?
Exactly. The investor sold the first fund when prices were low and the market rallied overnight. The buy order for the second fund then executed at a higher price the next day, causing them to miss that rebound. The source contrasts this with Vanguard, where exchanges between their own funds usually happen simultaneously at the 4 p.m. pricing.
So based on this anecdote, the lesson is to be cautious with using exchange functions for funds from different families, especially at a brokerage like Fidelity, as it might not be a true simultaneous swap. Maybe better to sell than immediately buy as separate orders.
Possibly, but that brings us to pitfall 6. Which describes a problem encountered by another investor at Vanguard, doing just that, albeit under different circumstances.
Oh. What was the issue there? Selling and then buying separately at Vanguard.
This investor was selling traditional Vanguard mutual funds and then placing a separate buy order for a different Vanguard fund, rather than using the exchange function.
Right.
After the sale executed, which happens at 4 p.m. for mutual funds,
Right.
the cash proceeds were not immediately available for the buy order. The system required settled cash or money market funds, which the investor didn't have enough of at that moment for the desired purchase size.
So they had to wait for the cash from the sale to settle, maybe a day or two, before they could place the buy order.
Correct. That meant the buy order was delayed until the next day after the cash had settled. And again, wouldn't you know it, the market rallied significantly that second day before the mutual fund purchase executed at the 4 p.m. closing price. The investor missed out on that gain.
Another timing-related issue caused by brokerage operations, costing the investor money they were trying to save. The source author was surprised by this, as Vanguard usually allows buying with unsettled funds, especially with ETFs.
It highlights how the specific type of security mutual fund versus ETF and the brokerage's internal processes can introduce unexpected timing risks, which leads us neatly into Pitfall 7.
Pitfall 7. Placing traditional mutual fund orders too early in the day. We touch on this briefly.
Yes. Remember that mutual funds are priced only once per day after the market closes at 4 p.m. ET. If you place a buy or sell order for a mutual fund early in the day, say at 10 a.m., that order won't execute until after 4 p.m. using the net asset value calculated at market close.
So you're exposed to market movements throughout the day, between placing the order and its execution price being determined. The price you see at 10 a.m. might be very different by 4 p.m.
Exactly. The source gives the example of placing a sell order for a loss position at 11 a.m., hoping to capture the loss at that price, but the market rallies significantly by 4 p.m. What you intended to be a tax loss could easily turn into a tax gain if the price recovers before execution.
Yikes. You place the order based on the current price, but the trade happens hours later at a potentially much different price. That's a real risk with mutual funds.
To mitigate this, the source recommends placing mutual fund orders much closer to the 4 p.m. close, perhaps around 3.50 UCO PMET, to minimize that price exposure gap.
Okay.
This risk is much less significant with ETFs, which trade throughout the day at prevailing market prices. You buy or sell, and it happens pretty much instantly at the current price.
Speaking of trading speed and accuracy, Pitfall 9 seems related. Getting the ETF trade done quickly.
It is. Pitfall 9. Not having a plan and being slow. Even with highly liquid ETFs that trade instantly, you want the minimum possible time between selling the lost position and buying its partner. The source author aims to complete the buy order within a minute or two of the sell order executing.
Within a minute or two. Why the urgency?
To minimize slippage. The price of a security can change quickly, especially in volatile markets. If you sell at a loss and then take several minutes fiddling around to place the buy order for the partner fund, the market could rise in that short interval.
Oh.
You'd end up buying the replacement shares at a higher price than you sold the original, and that cost difference can easily exceed the tax benefit you were trying to capture. You could lose more to slippage than you gain from the tax loss.
So the plan needs to be prepared in advance. Know which ticker to sell, which ticker to buy, and the exact amounts. Then, execute quickly and accurately. Click, click.
Speed and accuracy are paramount. Have the tickers and amounts ready before you start. The source also covers errors like accidentally entering the wrong ticker symbol, the wrong number of shares, or submitting 2 sell orders instead of a sell and a buy. Simple mistakes.
Yeah, easy to do in the heat of the moment.
Market slippage costs you money, but operational errors can be far more damaging.
Pitfall 10 touches on something that gives many investors pause. Using money from a sale that hasn't officially settled yet. Those scary brokerage warnings.
Yes, Pitfall 10. Worrying about buying with unsettled funds. When you sell a security, the cash proceeds don't officially settle in your account for, typically, T+2 business days. But you need to buy the replacement shares immediately for effective TLH.
Brokerages often show warnings about using unsettled cash or indicate funds aren't available for withdrawal. It makes you nervous.
They do, but the source reassures that with liquid ETFs, this is generally not an issue. The brokerage will typically allow you to place the buy order using the unsettled proceeds from the sale you just made. The buy order will also take 2 days to settle, by which time the cash from the initial sell order will have arrived to cover the purchase. It usually works out.
So, for liquid ETFs, trust the process despite the warnings. Though we saw in Pitfalls 5 and 6 that this isn't always seamless with traditional mutual funds.
Correct. It appears using unsettled funds is reliable for ETFs, but traditional mutual funds, particularly when moving between fund families or not using a dedicated exchange function, can have these delays we talked about.
That distinction between mutual funds and ETFs brings us to Pitfall 11. Seems important.
Pitfall 11. Swapping traditional funds for ETFs, or vice versa. This pitfall highlights the fundamental timing incompatibility between these 2 security types for TLH.
How so?
If you sell a traditional mutual fund, the trade happens at 4 p.m. ET, market close. At that time, the stock market is closed, so you cannot buy an ETF until the market opens the next day.
Which means you are out of the market overnight. Big risk if the market gaps up.
Exactly. If the market rallies overnight, you miss that gain entirely. Going from an ETF to a mutual fund is less problematic if you sell the ETF near 4 p.m. and buy the mutual fund also near 4 p.m., but there's still a small risk of market movement between your ETF trade and the mutual fund's 4 p.m. pricing.
So the advice is?
The source's strong advice here is to pick one type of security, traditional mutual funds or ETFs, for your taxable account and stick with it for TLH pairs. They generally recommend ETFs due to better trading flexibility throughout the day and often greater tax efficiency in how ETFs manage capital gains distributions compared to mutual funds.
Okay, consistency helps avoid timing traps. Pitfall 12 discusses the frequency of harvesting. Can you do it too often? Can you be too diligent?
Yes, apparently you can. Pitfall 12, tax loss harvesting frenetically. Some investors, or maybe automated services, try to harvest losses every time there's a small dip, daily or weekly.
Trying to capture every little loss.
Right. But remember, the wash sale rule means you can't buy back the same security or its partner you just sold for 30 days. If you're harvesting very frequently within that 30-day window for the same asset class, you need a growing number of partner funds to swap into.
So If I sell Fund A and buy Fund B today and the market drops again next week, I can't sell Fund B and buy Fund A again for 3 more weeks. I'd need a Fund C to swap into.
Precisely. And if it drops again a week later, you might need Fund D, and so on. Harvesting too often can lead to accumulating a surprisingly large number of different holdings in your taxable account, potentially 30, 40, or even more individual funds or stocks, just to manage the wash sale rule across different partners.
That sounds like a portfolio management nightmare, just keeping track of it all.
It can become very unwieldy. The source points out this can be a concern with some direct indexing services that harvest very aggressively, sometimes daily. If you ever decide to leave such a service, you might be left with hundreds of individual stock positions that are complex and costly to manage yourself.
Okay, so what's a more manageable frequency?
The source author's personal strategy, shared in the article, is to limit harvesting frequency to no more than once a month per asset class, or even less often, maybe every couple of months, to align with that 60-day qualified dividend rule we discussed earlier.
Okay.
This allows them to effectively use just 2 tax loss harvesting partners per asset class, keeping their portfolio much simpler. They just rotate between the 2.
They even list their specific pairs, like using VTI and ITOT as partners for U.S. total stock, or AVUV and DFSV for U.S. small value, VXU, SIXUS for international, and so on. Using just 2 partners per asset class makes management much more straightforward while still capturing plenty of harvesting opportunities over time.
It's a practical approach to balancing tax efficiency with portfolio simplicity. Maybe not squeezing out the absolute last penny of loss, but keeping things manageable.
Okay, we've covered a lot of traps. 12 pitfalls. What's the final one? Number 13.
Pitfall 13, overestimating the benefits. This is about keeping perspective. Tax loss harvesting is a valuable tool, an excellent optimization strategy, but it's not a magic bullet that will solve all your financial needs.
Right.
As we've seen, operational errors or misinterpretations of the rules can easily wipe out the benefits you were hoping for.
And the annual tax benefit from offsetting ordinary income is relatively small for high earners, just $3,000 a year against that income.
Correct. The source's calculation shows that $3,000 deduction saves about $3,361 annually in the top federal bracket. Useful, but not life-changing on its own. And if you build up a massive pool of losses, say $200,000, using only $3,000 per year against ordinary income means it would take over 66 years to use it all.
And unused losses expire at death, right? They don't pass to heirs.
Correct. They vanish. So where is the real power of accumulating a large pool of losses?
Okay, this is the key point.
The true power lies in offsetting large capital gains. This is where TLH becomes incredibly valuable for H&W investors. The source lists common scenarios. Selling a successful business, selling highly appreciated investment real estate, beyond the primary residence exclusion, of course, selling inherited stock with a very low cost basis, or significantly repositioning a large legacy investment portfolio during retirement or decumulation.
Those significant liquidity events or portfolio shifts that would otherwise trigger a massive capital gains tax bill. That's where the unlimited offset really matters.
Exactly. Having a large pool of carried forward losses allows you to significantly reduce or potentially even eliminate the tax liability on those large gains. That's where the unlimited offset against capital gains truly shines.
Okay.
But, and this is the essential point from Pitfall 13, TLH is an optimization tool. It's less critical to your long-term financial success than core principles like your savings rate, investing consistently in a diversified low-cost portfolio, and staying disciplined through market ups and downs.
It's a valuable enhancement to a solid financial plan, not a replacement for it. Understanding these pitfalls is clearly crucial to actually realizing the intended benefits. You have to execute it correctly.
Absolutely. Knowing where the traps are helps you avoid them and successfully capture those tax assets. Now let's shift gears slightly. We've focused mostly on traditional stocks and funds, but what about alternative investments? Private equity, hedge funds, real estate, commodities. These are common in H&W portfolios, and they have their own unique tax considerations.
That's a great transition, and our Amanito source delves into this. How does tax management look different when we move beyond traditional equities and bonds into these, alternative areas?
The key message from this source is that the tax rules for alternatives are often more complex and varied, and depend heavily on the specific asset class and its structure. Minimizing taxes in these areas requires understanding these specific nuances, which can sometimes interact with strategies like TLH from your traditional portfolio.
Okay, let's start with private equity. What are the main tax points there for investors?
For private equity, the focus is often on achieving favorable capital gains treatment. Like public stocks, gains from selling an interest held for over a year are subject to the lower long-term capital gains rates. The source also mentions that carried interest for fund managers is typically taxed at capital gains rates.
Okay.
A powerful potential benefit highlighted is qualified small business stock, or QSBS, under Section 1202.
QSBS, what's the tax advantage with that? Sounds
I
important.
can be huge. If an investment qualifies as QSBS and meets specific criteria, most notably a 5-year holding period, you could potentially exclude up to 100% of the gains from federal income tax, up to certain limits, usually $10 million or 10 times your basis.
Up to 100% exclusion. That's enormous. That could dwarf any loss harvesting benefits.
It absolutely could. And this is an example of how the tax features of an alternative asset class can influence the need for other strategies. If a significant portion of your return from a private investment is from tax-exempt QSBS gains, you might have less need for harvested losses from other parts of your portfolio to offset those specific gains.
Interesting interaction. Okay, how about hedge funds? They're known for their complexity both in strategy and structure.
From a tax standpoint, they are indeed complex. Hedge funds are usually structured as limited partnerships. This means income and losses pass through to the investors, who receive K-1 forms reporting their share of gains and losses, which they then report on their personal tax returns.
So investors deal directly with the tax consequences on their own return, not through the fund itself paying corporate tax like a regular company.
Precisely. This pass-through can sometimes enable tax deferral, depending on the fund's strategy. The source also notes that the fund's structure, particularly whether it's domiciled onshore or offshore, can have different tax implications. Offshore funds can be appealing for certain types of investors or specific investment strategies, which is relevant for globally diversified H&W portfolios.
And do hedge funds use tax management internally? Are they harvesting losses inside the fund?
They absolutely do. The source mentions that sophisticated hedge funds employ their own tax management strategies, including the strategic timing of gains and losses and tax loss harvesting within the fund, to improve the after-tax returns for their investors. It shows how ingrained tax optimization is at the institutional level.
Right, they're trying to deliver better net returns.
Yeah.
Let's move to real estate, a staple in many H&W portfolios. What are the key tax features here?
Real estate has several unique tax features. One major one is depreciation, which allows investors to deduct a portion of the property's cost basis each year against rental income.
Which lowers your taxable income from the property.
Exactly. It improves cash flow and reduces taxable income during the holding period. But you must be mindful of depreciation recapture when you sell. The IRS essentially claws back that depreciation benefit, and it's taxed at ordinary income rates up to a certain cap, not capital gains rates.
Okay, so the benefit isn't entirely free, and the powerful 1031 exchange.
Right. A 1031 exchange, or like-kind exchange, is a mechanism to defer capital gains tax when selling one investment property and reinvesting the proceeds into another like-kind property. You don't trigger the tax bill until you eventually sell the replacement property without doing another exchange.
So you can roll gains over and over.
Pretty much. It's a crucial tool for building real estate wealth tax efficiently, but it has very strict rules and timelines. It directly impacts when you realize gains, and thus when harvested losses from other assets might be useful.
The source also differentiates between passive and active income in real estate. Why does that matter for tax?
Yes. Rental income where you have minimal involvement is typically classified as passive income. There are specific rules about how you can deduct passive losses, usually only against passive income.
Okay.
If you are actively involved in managing the property, like a real estate professional, it might be considered active income. This can qualify you for more deductions against other income, but the income itself might also be subject to higher tax rates. The rules get complicated.
How about commodities, like metals or oil? How are they taxed?
Tax treatment depends on how you invest. If you hold physical commodities directly, such as gold bars or silver coins, any gain is treated as a capital gain. But here's a catch. It might fall under the category of collectibles, taxed at a higher maximum long-term capital gains rate of 28%, not the usual 15% or 20%.
28%.
Ouch. Yeah. You can potentially deduct costs like storage and insurance, though.
And commodity futures. Trading contracts rather than holding the physical stuff.
Commodity futures contracts have a special tax treatment under Section 1256. This is quite different. Gains and losses are subject to a favorable 60-40 rule. 60% of the gain or loss is treated as long-term capital gain loss, and 40% is treated as short-term capital gain loss.
Regardless of how long you held the contract, even if just for a day.
Exactly, regardless of the actual holding period. This benefits active traders by providing partial long-term rates, even on very short-term trades, and creates different dynamics for how losses can be utilized compared to standard equities. It's marked to market at year-end, too.
Interesting. Very different rules. Finally, venture capital, investing in startups. What are the key tax points?
Venture capital is focused on high growth potential. The tax implications here are often tied to the eventual exit strategy, whether the company goes public through an IPO or is acquired. Understanding the tax treatment of those specific events is crucial. QSBS, which we mentioned, can be a huge factor here too.
Right.
The source also mentions that some jurisdictions offer tax incentives, such as credits or deductions, to encourage investment in startups. These state or local incentives also play into the overall tax picture for a VC investment.
So the tax world of alternatives is really a mosaic of different rules and structures depending on the specific asset.
Right.
What are the overarching strategies the Armanino source recommends for optimizing taxes in this complex space?
The source emphasizes several key points. Be proactive with your tax planning from the very beginning of considering or making an alternative investment. Don't wait until tax time.
Makes sense.
Stay informed about the specific, often complex, tax laws and regulations that apply to each asset class, as these can change. Explore whether tax advantage structures are appropriate or available for your specific investment. Leverage tax loss harvesting strategies wherever they are applicable and beneficial within these asset classes or alongside them. Aim for long-term holding periods when possible to qualify for lower capital gains rates unless specific rules like Section 1256 apply. And critically, given the specialized nature of these rules, consult with qualified tax professionals who have expertise in alternative investments.
That last point seems particularly important. Navigating K-1s from partnerships, depreciation recapture rules, 151 deadlines, Section 1256 QSBS qualifications. It's definitely beyond the scope of typical investment taxes. You need someone who knows this stuff cold.
It absolutely is. Expertise is non-negotiable for effective tax management and alternatives. Trying to DIY this could be very costly.
Now, let's turn to a challenge that is incredibly common among H&W individuals, something we see all the time. Having a very large, concentrated position in a single stock.
Right.
Perhaps it's stock from their employer, or an inherited position, or an early investment that just grew and grew.
This is a scenario we see very frequently. Our sources define a concentrated stock position as having 10% or more of your total investment portfolio in a single stock. And sometimes it's much, much more than 10%.
Right.
While it might represent significant success, the reason you have wealth, it comes with substantial risks that often outweigh the potential upside of holding it indefinitely.
What are the main risks of being concentrated like that? It feels good when the stock is going up, but
the downside is brutal. Beyond the obvious risk of the company's share price simply falling, you're highly vulnerable to company-specific negative events, regulatory issues, product failures, scandals, management changes, competition. If a large portion of your wealth is tied to one company, and that company faces severe challenges, it can have a devastating impact on your entire financial life. The Mariner source uses the potent example of employees at financial institutions during the 2008 crisis.
oh yeah, Lehman, Bear Stearns.
Exactly. They often lost their jobs, potentially their retirement plans were hit, and they saw their concentrated company stock holdings collapse simultaneously. A triple whammy.
So your financial capital and your human capital are dangerously linked to the fate of one entity. The textbook solution, of course, is diversification. Sell the stock, buy lots of other things.
Exactly. Reduce your exposure to that single point of failure by diversifying into a broad basket of securities. However, here's a dilemma. For a stock that has appreciated significantly over many years and has a very low cost basis, selling it to diversify triggers a massive capital gains tax liability.
That potential tax bill is often the major barrier to diversification, isn't it? Even when the investor intellectually knows it's the right move, there can also be emotional ties to the company, loyalty.
Absolutely. Both play a huge role. The tax cost can feel prohibitive, like you're giving away a huge chunk just to diversify. Our Mariner source mentions several traditional tools used to manage concentrated stock, each with its own complexities and limitations.
What are some of those traditional approaches?
Well, for restricted stock units, RSUs, they are typically taxed as ordinary income when they vest, and some shares are usually withheld automatically to cover those taxes, so some of the tax burden is handled up front as you receive them.
Okay.
For restricted stock under Rule 144 or for insiders holding large positions, sophisticated planning is needed, often involving pre-scheduled sales plans, known as 10b5-1 plans, or even blind trusts to manage the sales process and insider trading rules.
What about net unrealized appreciation, NUA? That sounds technical.
NUA is a strategy specifically for highly appreciated company stock held within a company retirement plan, like a 401k. It's pretty specific.
How does it work?
If you take a lump sum distribution of that company stock from the 401k when you leave the company, instead of rolling it into an IRA, you pay ordinary income tax only on the stock's original cost basis. The large appreciation, the NUA, is then taxed at the lower long-term capital gains rate, but only when you eventually sell the stock from the taxable brokerage account you moved it to.
So you defer the tax on the gain and potentially get a lower rate on it compared to rolling it to an IRA where withdrawals are all ordinary income.
Exactly. It's a complex but potentially powerful tool for company stock held in retirement plans.
What about using options like puts or calls to manage the risk?
Options can be used for hedging, yes. Buying a put option gives you the right to sell your shares at a specific price, providing downside protection, like insurance. Selling a call option generates income but limits your upside potential and offers only limited downside protection.
And people combine them.
A common strategy is a cashless caller, where you buy a put and sell a call simultaneously, usually trying to structure it so the income from selling the call offsets the cost of buying the put.
So you're establishing a price range protected below the put strike price, but you give up gains above the call strike price, kind of locking in a value range.
Right. But option strategies are complex, involve costs, potential risks like assignment, and have their own specific tax rules, including potential constructive sale issues that could trigger gains anyway, and complications for incentive stock options if hedged too early. The source strongly advises professional tax advice before using options for this purpose.
Okay, definitely not DIY territory. What about gifting the stock away?
Outright gifting shares is often part of estate planning. You can give shares within the annual exclusion limits, currently $18,000 per recipient per year in 2024, or use part of your lifetime gift and estate tax exemption.
How does that help with concentration?
It reduces your concentrated position, gets it out of your potential estate, and passes the stock, along with your original low-cost basis, to the recipient. This shifts the potential tax liability to them when they eventually sell.
Okay, so it solves your problem, but potentially creates one for the kids later. And donating to a charitable remainder trust, or CRT.
This is another sophisticated strategy, often used for larger positions. You donate the highly appreciated stock to a CRT. You generally receive an immediate income tax deduction for the donation based on the present value of the remainder interest going to charity.
And the trust.
The trust can then sell the stock without incurring immediate capital gains tax because it's tax exempt. The proceeds are then diversified within the trust, and the trust provides you, or other beneficiaries you name, with an income stream for a specified period, maybe your lifetime. After that period, the remaining assets go to the designated charity.
So it's a way to achieve diversification and generate income without the big upfront tax hit on the sale within the trust, plus you get a charitable deduction.
Exactly. It's quite powerful, but involves legal setup costs and irrevocability.
These are all tools, but they have their limitations, complexities, or specific use cases like NUA or CRTs. This is where direct indexing emerges as a uniquely powerful, modern solution specifically for the concentrated stock problem for H&W investors, according to our sources.
Absolutely. Both the Russell and Mariner sources really highlight direct indexing's capability here. It seems almost tailor-made for this issue.
Let's define direct indexing again, just to be clear. It's different from owning an index ETF or mutual fund, right?
That's the key difference. Instead of buying shares of a pooled investment like an ETF or mutual fund that holds the underlying stocks of an index, with direct indexing, you directly own the individual securities that make up that index, or a representative sample of them.
So my account holds shares of Apple, Microsoft, NVIDIA, etc. individually.
Exactly. These are held in a separately managed account, or SMA, under your name. For large indexes like the S&P 500 or Russell 3000, the provider will typically use sophisticated sampling techniques rather than buying every single stock, but you still own hundreds of individual positions.
Okay, so you own the individual stocks. How does that feature make it uniquely suited to tackling the concentrated stock tax problem? What's the magic?
This is where the tax efficiency is unlocked. Because you own the individual stocks, you have granular control at the stock level. This allows for continuous, active tax loss harvesting within that diversified portfolio of index components.
So even if the overall index is up, some individual stocks within it will likely be down.
Precisely. Even in periods where the overall market or index is going up, individual stocks within that index will inevitably be trading below their purchase price at various times due to sector rotation, company news, or just random volatility. Direct indexing allows you to systematically sell those individual losers.
And how does harvesting losses from the individual stocks in the direct index help with the tax bill from selling the other highly appreciated concentrated stock?
This is the crucial link. When you decide it's time to sell a portion of your concentrated, highly appreciated stock, which will generate a significant long-term capital gain, you can use the pool of tax losses that you've accumulated through ongoing tax loss harvesting within your direct index SMA to offset that capital gain.
So the losses you've captured from the direct index counteract the gain from selling your concentrated position, dramatically reducing or potentially eliminating the tax liability on the sale, allowing you to diversify much more efficiently. Wow.
That is precisely the power of it. It allows you to implement a diversification plan that might otherwise be cost prohibitive due to the immediate tax hit. Instead of paying, say, 20-30% or more of the sale proceeds to the IRS when you sell that concentrated stock, you can use the harvested losses to reduce or eliminate that tax, keeping more capital working for you, reinvested in that diversified index portfolio.
That sounds incredibly effective, and the sources mention that direct indexing provides flexibility and how you manage this transition out of the concentrated stock. It doesn't have to be all at once.
Yes. You can structure the diversification process gradually based on your financial goals and tax situation. For example, you might work with your advisor to determine an amount of capital gain you are comfortable realizing and paying tax on each year, using harvested losses to bring the net gain down to that target level.
Or you can spread the sale of the concentrated position out over several years, maybe 3 or 5 years.
Exactly. You could plan to sell, say, 20% of your concentrated position each year for 5 years. Each year you sell that portion, triggering a large gain. You deploy the losses harvested from your direct index SMA to mitigate the tax on that specific year's sale.
Okay.
The Russell source mentions this is particularly useful for executives who need to sell company stock, perhaps when changing jobs or retiring. Direct indexing provides a strategic pathway to manage that sale tax efficiently over time rather than facing one giant tax bill.
This approach of using direct indexing to generate tax losses to offset a future known gain seems like it could be useful beyond just concentrated stock. What about other big gains?
It absolutely is. The Russell source specifically discusses using direct indexing proactively to prepare for other anticipated large capital gain events or financial windfalls.
Like selling a business or investment property.
Exactly. If you know you will likely sell a successful private business, a significant piece of investment real estate, or even just a large, highly appreciated, non-concentrated stock position down the road, say in 5 or 10 years, you can initiate a direct indexing strategy today.
And start building up that pool of tax loss assets in advance. Banking losses for the future gain.
Precisely. By actively harvesting losses within the direct index SMA over the years leading up to that windfall event, you are building a pool of tax credits, essentially those carry-forward losses that can be used to offset the large capital gain when it eventually occurs.
That's smart.
Starting early gives you time to accumulate potentially significant losses, especially if there are market downturns along the way, and allows the strategy to adapt to market conditions over that period.
So instead of just reacting to a massive tax bill when a windfall happens, you've proactively generated the tools to counter that bill for years beforehand. That's really powerful proactive planning.
It transforms a potential large tax liability into an opportunity for long-term tax optimization and wealth preservation. It's using the tax code strategically over time.
Beyond this powerful application for concentrated stock and windfalls, what are the other key benefits of direct indexing for H&W investors mentioned in the Russell source? It seems like there's more to it.
Oh, definitely. Tax efficiency is a major theme, but it extends to several areas beyond just loss harvesting. For instance, unlike mutual funds, which are legally required to distribute any net internal capital gains to shareholders each year.
Right, those phantom gains you get taxed on even if you didn't sell.
Exactly. Those can create unexpected tax bills even if you haven't sold the fund shares. With direct indexing, because you own the stocks directly, you control when gains are realized on the individual stocks you own. You can avoid these unwanted distributions.
More control over gain realization.
And as we discussed, the losses you harvest can offset gains from anywhere in your portfolio, other stocks, bonds, real estate, whatever, not just within the SMA itself. Plus, they offset the $3K of ordinary income and carry forward indefinitely.
Customization is another significant benefit you mentioned, isn't it? The ability to tailor the portfolio beyond just the index.
Absolutely. This is a huge draw for many H&W investors. Because you directly own the individual stocks, you can customize the portfolio based on your specific needs and preferences in ways you just can't with an ETF or mutual fund.
Like excluding certain companies or industries.
Exactly. This could involve excluding specific stocks or entire sectors you don't want to own for ethical reasons, social concerns, or governance issues, think ESG screening, or maybe for faith-based principles, or simply personal beliefs like avoiding tobacco or firearms stocks.
Or maybe you already have too much exposure to one sector through your job or other holdings.
Right, you could underweight a sector. Conversely, you can overweight specific areas you feel strongly about or want more exposure to. This level of personalization is simply not possible with pooled funds where everyone gets the same basket.
So your investments can more closely align with your values or specific market views, or complement your existing holdings.
Exactly. Risk management is also cited as a benefit. By mirroring an index, you achieve broad diversification inherently. While customization and aggressive TLH can lead to slight deviations from the benchmark's performance that's known as tracking error,
Right.
this is usually considered an acceptable trade-off for the potentially significant added tax benefits and the value of customization.
And impactful charitable giving. How does direct indexing help there specifically?
It allows for very tax-efficient charitable donations. Since you own the individual stocks, you can identify and donate specific highly appreciated shares from your SMA directly to a charity or a donor-advised fund.
Instead of donating cash.
Right. By donating the appreciated stock directly, you generally receive a tax deduction for the full fair market value of the donated shares, and you avoid realizing the capital gain that would occur if you sold the shares first and then donated the cash.
Double tax benefit? Potentially.
Yes. And this is particularly impactful if you want to donate shares of a company that aligns specifically with the charity's mission, maybe donating tech stock to a STEM education charity, for example.
That's a smart way to integrate philanthropy and tax strategy. We talked earlier about the frequency of tax loss harvesting being important, especially with direct indexing. Can you elaborate on why doing it more often matters?
Yes, the Russell source highlights this as a key differentiator between direct indexing providers. They argue, convincingly I think, that providers who harvest losses more frequently, for example, monthly or even more often, instead of just quarterly or annually, capture significantly more opportunities to realize losses.
Even in a year when the overall market or index is rising, that seems counterintuitive.
Absolutely, and this is a crucial insight. The source provides data showing that even in strong market years, like when the S&P 500 is up significantly year to date, a considerable percentage of the individual stocks within that index will still have negative year-to-date returns at various points throughout the year, particularly during those inevitable intra-quarter dips or sector rotations.
So while the index average is climbing, there are always individual stocks within it that are temporarily down and available for harvesting if you're looking frequently.
Precisely. The data from the source for various indices like the S&P 500, Russell 3000, MSCI, World XUSA shows that even in very positive overall market years, the percentage of individual stocks showing a loss year to date at their intra-quarter highs often ranged from roughly 30% to over 80%, depending on the specific year and index.
Wow, that high.
Yeah, it's surprising. Harvesting monthly or even more frequently simply increases your chances of identifying and capturing those individual stock losses before they potentially recover, thereby building a larger pool of tax losses over time compared to only looking quarterly or annually.
More frequent harvesting means accumulating a larger tax asset, that pool of losses we discussed, using against future gains. Makes sense.
That's the benefit. It maximizes the tax efficiency, the tax alpha that direct indexing offers. It's a key part of the value proposition.
So if direct indexing seems like a strategy that fits your situation, particularly if you have concentrated stock, anticipate future windfalls, or really value customization and tax efficiency, how do you go about choosing a provider? What should you look for? Seems like a complex decision.
It is, and the Russell source provides a helpful list of key considerations. First and foremost, look at their tax management experience. This is the core capability, right? Their proven track record in implementing sophisticated tax loss harvesting and managing capital gains effectively is absolutely essential.
So they should be specialists in this area, not just general investment managers who bolted on TLH.
Ideally, yes, or at least have very deep demonstrable expertise. Second, evaluate their track record and expertise in managing index portfolios more broadly. Look at their historical performance while understanding past performance is not a guarantee, of course, and their depth of understanding of tax management techniques, including, critically, how frequently they actually harvest losses.
We just heard that monthly or more often is better than quarterly. That's a key question to ask them directly.
Right. Third is flexibility. Can they seamlessly integrate with your existing accounts and holdings? Are they equipped to handle complex transitions, like systematically managing down a large concentrated stock position and coordinating the harvesting and selling over time?
And closely related, transition management seems critical, especially if you're moving existing appreciated assets in.
It is. Look for providers who offer clear support and analytical tools to help you transition your existing portfolio, especially those appreciated holdings, into the direct indexing strategy in the most tax-efficient way possible. They should guide you through that migration process, not just dump it on you.
What about account minimums? Direct indexing used to be exclusive to the ultra-high net worth, like $5 or $10 plus. Is that still true?
It's definitely becoming more accessible, but minimums still vary quite a lot. The source notes that providers using a purely passive index replication approach might still require higher minimums, maybe $500 or $1 mil plus. However, some providers incorporating active management overlays or using more optimized sampling might have lower account minimums, maybe $250K or even $100 in some cases, so it's worth checking.
Okay, more accessible, but still generally H&W territory.
Yeah.
Criterion 6 is research and investment methodology. What does that entail?
Understand their approach to portfolio construction and management. Look for transparency in their methodology. How do they select securities if they sample? How do they manage risk? What's their overall investment philosophy? Ensure it aligns with your own goals and risk tolerance.
Customization options are a core benefit, so that's a key criterion to evaluate. How much tailoring can they really do?
Yes. Assess the range of customization they offer. Can you exclude specific stocks or entire sectors? Do they support values-based screening like ESG or faith-based criteria? Can they tailor the portfolio to your unique needs and preferences, or is it just of a few preset screens?
And do they offer passive, active, or both approaches? Does that choice matter?
This gives you choice. You might prefer a strict index tracking strategy focused purely on tax alpha, or you might want an actively managed approach hoping for benchmark outperformance in addition to tax benefits. Or maybe a blend. A provider offering flexibility allows you to select the model that best fits your overall investment strategy and preferences.
Finally, cost structure and industry recognition. Got to understand the fees.
Absolutely. Understand the fees clearly, the asset management fee, any overlay costs for customization or active management, potential trading costs, etc. Make sure the total cost is justified by the value and benefits, especially the tax alpha you expect to receive.
And industry recognition.
And look at their industry recognition, reputation, and longevity. A provider with a long history, significant assets under management in direct indexing, and a strong reputation is likely better equipped to handle these sophisticated strategies reliably over the long term.
So choosing a direct indexing provider requires careful due diligence, really digging into their specialization in tax management, their specific capabilities, flexibility, how they handle transitions, and their overall approach to both investment management and tax optimization.
Absolutely. It's about finding the right partner whose expertise and platform can effectively implement these advanced strategies to meet your specific goals for tax management, customization, and overall wealth growth. It's not a commodity product.
We've covered a significant amount of ground today. We started with the foundational concept of tax loss harvesting, dove into the surprising number of ways people stumble, even with the basics, those 13 pitfalls.
Yeah, quite a list.
Explored the distinct tax landscapes of alternative investments, and then really focus on how advanced strategies, particularly direct indexing, provide powerful solutions for common high net worth challenges like managing concentrated stock positions and preparing for future windfalls.
The key takeaway, I think, is that for high net worth investors, effective tax management needs to be a proactive, integrated part of your investment process, not just a reactive exercise you do with your accountant once a year at tax filing time.
Right. It's ongoing.
Leveraging tools like strategic tax loss harvesting throughout the year, understanding the tax nuances of all your asset classes, alternatives included, and employing advanced solutions like Direct indexing, where appropriate, can have a really profound positive impact on your after-tax wealth accumulation over the long run.
It's about thinking ahead, isn't it? Anticipating those significant capital gain events, selling the business, the property, diversifying that stock, and actively building tax assets, those pools of carried forward losses that can directly offset those future liabilities.
Exactly. The potential tax savings aren't just that $3,000 ordinary income deduction each year, although that's nice. The real power is potentially saving hundreds of thousands or even millions in capital gains taxes over your lifetime by strategically offsetting those large gains when they occur.
That's where the big money is saved.
And given the complexity we've discussed today, particularly with alternatives, concentrated positions, wash sale nuances, and implementing strategies like direct indexing correctly, the consistent advice echoed across all the sources we reviewed is crystal clear. You don't need to navigate this labyrinth alone. In fact, you probably shouldn't.
Working with qualified professionals, tax advisors who understand investment complexity, wealth advisors, financial planners who specialize in these areas for HNW clients is really essential, isn't it?
It truly is. They can help you understand the intricate rules as they apply to your specific situation, tailor strategies appropriately, ensure compliance, which is critical, and help you unlock the full potential of these sophisticated tax management techniques. Leveraging that expertise is crucial for effective implementation.
This has been a really deep dive into some sophisticated tax strategies specifically relevant for high net worth investors. We've explored the core of tax loss harvesting, highlighted the critical pitfalls to avoid, examined the tax considerations and alternative investments, and showcased how direct indexing offers a powerful approach to managing concentrated stock and preparing for future windfalls.
The potential benefits: significant tax savings, enhanced after-tax returns, the ability to diversify concentrated wealth much more tax efficiently, and greater control over your portfolio's tax profile and even its alignment with your values can be substantial. It really frees up capital to pursue your other financial and philanthropic goals.
Yeah.
It truly is about converting potential tax liabilities into opportunities for optimizing your wealth.
So here's the provocative thought to leave you with as we wrap up. Looking at your own financial picture, your mix of investments, any significant concentrated stock positions you might hold, any large liquidity events you anticipate in the future, maybe selling a business or property, are you fully confident you are actively leveraging every available tax strategy to optimize your after-tax wealth? Or could taking a deeper look, perhaps with the guidance of the right expertise, reveal significant untapped opportunities to enhance your financial future?
Something certainly worth exploring for anyone in that situation.
Indeed. Thank you for joining us for this deep dive.
Always a pleasure. Until next time.